Okay, now we are going to discuss a very important topic, revaluation of non-current assets. I mean, it is important from the logical point of view that we need to revalue the assets sometimes. And it is also sometimes a little bit tricky for exam calculation point of view. So let me explain you the concept of revaluation, you know, what it is and why it is. So you prepare, accounting records, and then you have to present that accounting data in form of financial statements to the shareholders and to the other group of stakeholders. One of those financial statements is called balance sheet, which is balance sheet is the traditional name. The new name is called Statement of Financial Position, SOFP. And on your balance sheet, you mention all the assets which a business possesses. Now, among those assets, some assets you have just purchased probably very recently, and there are some assets which you have purchased probably many years ago. And we know that most of the assets, they depreciate in value. Our previous topic, which we have been discussing for almost 2 hours, was about depreciation. We say that assets, they depreciate. Depreciate means they lose value. Motor vehicles, they lose value. Machinery, plant equipment, it loses value. Computer equipment loses value. Furniture loses value. But there are some assets which may increase in value. Their value appreciates. So depreciation means loss in the value. Appreciation means increase in the value. So some assets, so just like you are depreciating the assets so that you show the correct value of the asset. Similarly, some assets, they may increase in value. Just to give you an example, let's suppose that we purchase some office building, some office premises for $100,000. We purchased it in 2015. Today it is 2023. And if you come and still tell me that the office is still 100K, I probably will have doubt on your common sense. I would say that, see, this was 100K probably 10 years ago, 8 years ago. Now the property prices have gone up. And in the balance sheet, you are telling me that the asset is still 100K. So it means that you are not giving me a fair view, a true and fair view. You are not reporting me correctly. Why are you putting this building for 100,000? You say, because I purchased it for 100,000. And then I say, okay, you purchased it 10 years ago. Now it is not 100,000. So this is the time, so you ask me, okay, then what should I do? I say, then you need to revalue your asset. You need to revalue your asset so that the value of asset in the balance sheet, it should match with the value of asset in the market. Because in the market, this kind of office premises is now for 200,000. And you are telling me that it is only 100,000. So I do not agree with you. So this is the concept of revaluation. Now here, IFRS actually, it allows you that end of the year, when you prepare your balance sheet and when you report your assets, they say that you can show your assets on 2 methods. IAS 16 allows you a choice between keeping the asset at cost model or keeping the asset at revaluation model. You call it revaluing or fair value. So let's call it revaluation model. So what is cost model? Cost model was, which we already have seen, that, I purchased the asset for 20,000. I'm continuing the same numbers which we have been discussing for the last 2 hours, okay? I purchased an asset for 20,000. I charge depreciation 3,000 for year 1. So end of the year, the value of asset is 17,000. End of year 1. For the next year, again, I charge a depreciation of 3,000. and I say that my asset is now 14,000. So this is the net book value end of year 2. This is the net book value of end of year 1. This is called cost model. When I say keep the asset at cost model, it does not mean that you keep the asset at 20,000. What was your cost? Your actual cost what was 20. So I say keep the asset at cost model does not mean that you put it at 20,000. Actually, cost model means cost minus accumulated depreciation, whatever happened so far. So my cost was 20,000. I do not change it. I do not match it with the market. I bought it for 20,000. 2 years have passed. 2-year depreciation was 6,000. And now the net book value is 14,000. This is one method which IAS 16, tangible non-current assets, PPE, property, plant and equipment, it allows you. They allow you that you can do so. Alternatively, they say that you can use another method which is called the revaluation model. Revaluation model, it says that although you purchase this asset for $20,000, but end of the year, you have this opportunity to determine that what is the fair value or the market value of this asset is, and then accordingly you change it in your balance sheet. You increase, you revalue the asset. When I say revalue, it means I'm talking about upward revaluation. I'm talking about upward revaluation, which means increasing the value of asset in your books. So you can choose this method, you can choose this method. And you can choose both of them. You can choose both of them. What do I mean by both of them? Because there are some assets which are small in value, and finding out their market value every year is not very material, is not very significant. For example, my computer equipment. For example, my furniture. Maybe my vehicles. These are generally not very huge in value. They are not in millions of dollars. And finding out their market value, adjusting their value, that is a lot of pain without any significant or material difference. So we say, let's do it at cost model. But there are some other assets which are huge in value, in millions of dollars. For example, land and building. We have some land and building, a property in our balance sheet. When we purchased it, it was 5 million. Probably now it is 7 million. So if I am still putting it at 5 million, actually there is quite a big difference in the value of the asset. So we do revaluation of significant assets, and we do it almost every year, or at least once in 3 years. So land and building is done revaluation. Sometime plant and equipment or machinery, which is also very expensive, this is also revalued. So revaluation is actually a process in which you adjust the balance sheet value of the asset with the market value. This is the concept of revaluation, okay? And like I said that, you can choose both of them. Some of my assets, I will use cost model, and some of my assets, I will use revaluation model. But again, the principle of class will apply. If I say that land and buildings will be on revaluation model, then all land and buildings will be on revaluation. If I do revaluation of one building, I need to do revaluation of other buildings as well. If I say that I will put vehicles on cost model, then all of my vehicles will be on cost model. It is not possible that some vehicles on cost model, some vehicles on revaluation model, etc. Okay. So this is just a very quick introduction or overview of revaluation. Now we need to see that now this thing actually, the revaluation, because this topic now I'm not going to discuss cost anymore because this session is about revaluation. In revaluation, we need to do 3-4 things. Number one, we have to calculate how much is the revaluation. And by the way, revaluation is actually a gain. Now here I will introduce you two words. One word is called profit and one word is called gain. Okay, so there is a difference in these two terminologies. Profit is something which comes from my operations. Actually, both are benefit for me. They both are source of income for me. They both are source of income for me. They both are my benefits. But profit is something which I earn through my operations, and gain is not from it is also my income, but not from my operations. For example, in this particular year, we made, when we bought and sold goods or we provided services, we made our income statement, our profit is 1 million. Okay. At the same time, I had this building value was 5 million and that was revalued to 7 million. So I made a gain of 2 million. Okay, so I've got, this is also my benefit, this is also my income, but this is called gain. This is not called profit. So when I use the word revaluation, so when you do revaluation, as a result of revaluation, you calculate or you find out revaluation gain, which means that how much you have earned through the revaluation of your asset. So we call it revaluation gain. Okay, how to calculate that? We will see it. And we will try to do it with the help of an example. So it says that an entity may choose to revalue its assets rather than hold them at cost. This is a choice of accounting policy. Yeah, I explained you that IAS 16 allows you both policies, cost or revaluation, and most companies, they use both of them. Some assets, they use cost model, while major assets, big assets, they used revaluation model. We do it in example, okay, because it will be easy or helpful to understand it through some numbers. It says that an entity purchased an asset for $100,000 with a useful life of 20 years. At the beginning of the seventh year, it was established that the fair value of the asset was $120,000. Now, in this particular case, they did not tell you that this was an asset which has a life of 20 years. So it means that you must depreciate it. But which method of depreciation should you use? Should you use straight line method or should you use reducing balance method? If you remember in the previous lecture, I told you that if they do not tell you the method of depreciation, then by default, you should use straight line method. So we are going to use straight line method. The second thing, they did not tell us the residual value of this asset, that what would be the value of this asset after 20 years. Again, from the previous lecture, you remember, I told you that if residual value is not given, then you have to assume that residual value is 0. You have to assume it's 0. So because these two information are not given to us, what I'm going to do, I'm going to use straight line method of depreciation, and I will assume that residual value is 0. Residual value 0 means that this $100,000 worth of asset will become 0 in a period over a period of 20 years. Residual value 0 means that straight line method, if you remember cost of the asset 100,000 minus residual value 0 divided by life 20. So it means that your annual depreciation for this asset is $5,000, because a $100,000 asset will become zero over a period of 20 years. It means that every year this asset will lose 5,000. So from 100,000, first year it will lose 5, net book value will become 95. Second year, 5,000 depreciation, net book value will become 90. Third year, 5,000 depreciation, net book value in the balance sheet become 85. Net book value, carrying value is same. End of year 1, your net book value in your statement of financial position in your balance sheet is 95,000. End of year 2, you show your net book value or carrying value in your balance sheet 90,000. And end of year 3, it is 85,000, and so on. Now, so what I've been doing, I purchase the asset 100,000, and every year 5,000, 5,000, 5,000, I am decreasing. It says at the beginning of the 7th year, not at the end of the 7th year. You need to be careful about this language. I purposely wrote this word, beginning of the 7th year. Beginning of the 7th year means that 6 years have completed. 7th year has not completed yet. So it is 1st of January of the 7th year. So it means that 6 years have passed. And every year my depreciation was $5,000. So it means that my accumulated depreciation so far at this point in time, at the beginning of 7th year, my accumulated depreciation, my total depreciation was 30,000. Now asset cost was 100,000. And in 6 years, I have already depreciated it by $30,000. So it means that the carrying value, the net book value in my books for this asset is $70,000. So this asset actually at this time, at the beginning of 7th year, this asset in your balance sheet, or maybe end of last year, end of the 6th year, the balance sheet value of this asset was 70,000. And then what do you realize? You realize that the fair value, the market value of the asset is 120,000. Market value of the asset is 120,000. So what is happening? You come to me, you show me this piece of paper, this piece of paper. You say, sir, this is the balance sheet and it has an asset of 70,000. And I say, what are you talking about? 70,000? I just checked in the market, it is 120,000. So you are understating the asset. And you say, oh, that's a good news. That is a good news. We made a revaluation gain of 120 minus 70, the difference of these two, 50,000. We made a gain of 50,000. Let's celebrate it. We are very happy because we thought that our asset in the balance sheet is 70, market is 120. I'm very happy. First thing is called revaluation gain. Now, what do we do with this revaluation gain? By the way, this revaluation gain is called unrealized gain. Unrealized. You will use this terminology unrealized very frequently as you will move on with your accounting subject. Unrealized means something which has not been converted to cash. Because you as an accountant come in and says, sir, I've got a good news for you. We made a gain of $50,000 on the property. I say $50,000 gain, that's a very good news. Give me that cash. Give me this money, I'll go home. Maybe I'll take this money and I'll go on vacations. I'm waiting for my vacations. Give me 50,000. Can you give me $50,000? You cannot, because it is just on papers. This asset, this building has not been sold. So gain is there. In the books, it is there. On the balance sheet, it is there. but it is not physically available in form of cash. So we call it unrealized gain. Okay. So revaluation gain is an unrealized gain. $50,000 of revaluation gain we made under this situation. Now, what does this question says? Required. 4 things you need to understand when you do this revaluation questions. Number 1, you have to calculate how much is the revaluation gain. We just did it. Number 2, record the revaluation gain. Record the revaluation gain means the double entries, the debit and credit. And number 3, extra depreciation. Extra depreciation, because remember, before my asset was $100,000 and I was dividing it with 20 and I was calculating depreciation 5,000. Now the value of asset has increased. So naturally speaking, depreciation will also increase. So old depreciation and new depreciation. Whenever you will do revaluation, you need to calculate new depreciation. After revaluation, you must calculate the new depreciation. And the difference between the old depreciation amount and the new depreciation amount is called extra depreciation. And finally, you have to show the revaluation account at the end of the year. So these are the 4 things. Now, if you go to exam, it is quite possible they ask you only this thing, calculate revaluation gain. That's all. 2-mark question. Or they may ask you calculate extra depreciation. 2-mark question. Or they may ask you calculate revaluation gain account at the end of the year. Only one thing. They don't ask this. They don't ask this. They will only ask this. For the sake of this subject, I do not expect that they will ask you all 4 things in one question. They will not. They will ask you any one of them. But I'm going to show you how to calculate all 4 of them so that whichever they ask you in exam, you should be confidently responding to that question. So calculate the revaluation gain. Let's start this question now. So see, we have to calculate 4 things. This lecture, this revaluation topic, it takes me approximately close to 20 minutes, okay? And sometimes maybe more than 20 because I sometimes speak extra. I speak more, so it takes more time. So approximately 15 to 20 minutes you have to listen to me. Okay. Step number 1, calculate the revaluation gain. So revaluation gain will be the difference between the net book value or the carrying value, which in our case was 70,000 on the balance sheet, and the fair value or the market value, which is 120,000. It is the difference between these 2 numbers. Okay. So what happened in case the annual depreciation is 5,000, beginning of this, not beginning of the 6th year, beginning of the 7th year. This is my typo mistake because question says beginning of the 7th year means 6 years have passed. Total depreciation is 30,000. If total depreciation is 30,000, then your carrying value is 70,000. Your fair value is 120,000. And as a result, your revaluation gain is 50,000. This is which we just calculated in the previous slide. Revaluation gain, unrealized gain, $50,000. We are very happy. So when you came to me and you said, we've got this gain 50,000, I say, give me cash. You say, I don't have cash because we have not sold this asset. Asset is still we are using. I say, then what benefit will it give me? You came to me with a very big news that we made a gain of 50,000. And now when I ask you to give me money, you are not giving me anything. So what benefit does it bring to me? So you say, Mr. Ali, I'm not giving it to you in cash, but I will write it down in the balance sheet under your account. Under your account. I am the shareholder. I am the owner. Owner account is what? Owner account, if you remember, is called equity. On the balance sheet, you have one section which is called equity. Equity is the money which belongs to the owners. And under equity, I will create one section called reserves. And I will put $50,000 there. So that even if we are not giving it to you, we are writing it down in your name on the balance sheet. And when this asset will be sold, we will give you the money. I say, okay, fine, I agree. No, I don't want to argue with you. I understand 50,000 gain. Don't give it to me, but please put it on the balance sheet where my money is, where my money lies, under the equity section. And you say, no worry, I will do that. So I will not forget. Anyways, step number 1, calculate revaluation gain. Step number 2 is very important. Step number 2 was record the revaluation gain. Record the revaluation gain. What are the double entries, or how do the T accounts would look like? See here. Sometimes some students, they think that revaluation gain is income, and our income has increased, and we know the rule of debit and credit. Whenever income increases, we credit it. So you think that we should say credit 50,000, and you write down here revaluation surplus. So this is the name of the account. For revaluation gain, it goes to an account which is called revaluation surplus. And you say debit non-current asset by 50,000. I remember that if I asked students what should be the double entry for this 50,000, so they would say that, sir, asset goes up by 50,000, income goes up or gain goes up by 50,000. So debit asset 50,000, which has increased in value because it was 70. Now it becomes 120. So asset has gone up by 50,000. So let's debit the asset with 50,000. And because income has increased, so credit income by 50,000. This is wrong. This is not the way. Actually, this is correct. This is okay. But this is not correct. This is not correct. Asset has not increased by 50,000. Listen. Now, this is very important point to understand. If you come to me and you say that the asset was 70 in the balance sheet and now it has gone up to 120, asset has increased by 50,000. My comment here is that asset has not increased by 50,000. You know, asset has only increased by 20,000, in my opinion. In my opinion, asset has only increased by 20,000. I mean, in the balance sheet, it looks like this. 50,000 it looks. But in reality, it is not. You know why? Because when you purchased it, it was 100,000. It was 100K. You depreciated the asset for 6 years. You made it until 70. And now it is going up to 120. This is what has happened. Asset was 100. You depreciated in your books based on your estimate. You decided that I want to depreciate 5,000, 5,000, 5,000 every year. And in 6 years' time, you brought down the asset in your books to 70,000. And now it goes up to 120. And you are saying that, oh, I made 50,000 gain. No, actually asset was 100,000 back then, and it is 120,000 now. The change in the value of asset is only 20,000. The remaining 30,000 is your depreciation. Asset has only gone from 100 to 120. You see this one. Okay, let me just. Until here, what I should be doing from this point to this point, this is 30. First, I should think like this is the depreciation which I charged. So actually what was happening? You thought that asset is losing 5,000 every year. So in your books, you were decreasing the value of asset by way of depreciation, 100 to 95 to 90, 85, 80, 75, 70, and so on. This is what you were doing sitting in your room under some air conditioner. Whereas in the market, the reality was that asset was increasing in value. Asset was increasing in value. You see, asset went up. Asset did not depreciate. So for me, this 30,000 which you charge depreciation and decrease the value of asset was not a good thing. So I say that asset is 70, bring it back again to 100 by the depreciation which you charged, and probably you should not have charged, and then add 20K on the top because asset has only increased. Now, within this 50,000, actually 30,000 is your depreciation which you charged, and 20,000 is the increase in the value of asset. See, asset from 100 to only 120. Asset went up by only $20,000. You see 50,000 because you made asset to 70. You charge depreciation. Okay, so the real increase in the value of asset is only 20,000. Remaining is the depreciation. So what do I do now? What did you do? You charged 30,000 depreciation. Asset was not losing value, but you were depreciating it. Please reverse this depreciation. Reverse this depreciation. When you reverse the depreciation, asset will automatically become 100K. Why this asset was looking 70? You know what? 100K minus this 30K accumulated depreciation, and then asset was 70. I say this one should be reversed. Reverse this accumulated depreciation so that asset becomes again 100, and then I add 20, the increase, and I make it 120. So the double entry for this, now I hope that this logic you understood. Even if you understood it 70-80%, when you will see the double entries, the remaining part you will also understand. See here, this is recording. The second part is recording. So revaluation gain is 50,000. I'm fine with that. But asset I'm increasing only with 20,000, debit 20,000, and accumulated depreciation I make accumulated depreciation debit by 30,000. You know what? Because what you were doing in last years, you were saying debit depreciation expense 5,000, credit accumulated depreciation 5,000. And you repeated this double entry for 6 years. And therefore, in your accumulated depreciation T account, 30,000 was looking here. 30,000 was there. So you were crediting the accumulated depreciation, and you credited it 6 times. You were charging depreciation and you were crediting it. Now you have to reverse back all the accumulated depreciation. I say bring back asset to its original 100,000. Remember you said 100,000 minus 30,000 accumulated depreciation gives me 70. I say take it away. Remove this accumulated depreciation. So how do you remove it? You don't have an eraser to rub it. In accounting, if you have to remove something or if you have to reverse something, so if previously you made it a credit, now you make it a debit. So it was credited 30,000, now you make it a debit 30,000. So what happened? Before, it was looking like, it looked like that non-current asset 100K on the debit side. Over a period of 6 years, accumulated depreciation 30K. This was debit, this was credit, and the net book value was 70,000 because asset minus accumulated depreciation 70,000. I say remove it. So what I do, I make a debit to accumulated depreciation. Now asset accumulated depreciation has become 0 because it was 30 credit, 30 debit. And then I add only 20,000 to the asset. Debit non-current asset with 20. You know what? In the beginning, I said that some students will say that debit non-current asset with 50K and credit revaluation with 50K. That was wrong because if I put here 50,000, it will look like asset 150K. Asset never became 150. Asset was 100, now 120. How can you make asset 150? So therefore, what you need to do, remember the rule, whenever you do revaluation, now I'm putting it in simple words, I gave long explanation, but I can sum it up. Whenever you do revaluation, the first thing what you need to do is that whatever accumulated depreciation you have to reverse all of that accumulated depreciation by making it a debit. When you make it a debit, by making it a debit, now asset is standing there and there is no depreciation. As if the asset is born today, as if the asset has come to you today. There is no accumulated depreciation. I made accumulated depreciation 0 because 30 credit, 30 debit. Always the first step is that you reverse your accumulated depreciation. Whatever accumulated depreciation you have charged in the previous years, you make it 0 by reversing it with a debit so that the asset becomes 100. Now, if I ask you what is the net book value? 100. Because this is 100, this is 0. So 100 minus 0 is 100. Now my asset comes back to its original cost, 100,000. No depreciation charge so far. It is new. Now I make a difference between this 50 and 30 is 20. That I make a debit to non-current asset. And then I say credit revaluation surplus. So this is the process of creating the double entry. Step number 1, record the revaluation gain with a credit. Step number 2, reverse all of the accumulated depreciation. Step number 3, the difference of these two charged to the non-current asset. And now this is what I have actually put up here in that T account. Accumulated depreciation 30,000 debit, you make it 30,000 credit. Non-current asset, you add 20,000, and revaluation surplus goes to 50,000. So revaluation surplus 50,000. This is debit. Debit 30,000, debit 20,000, and credit 50,000. Your double entry is done. So far, so good. Revaluation surplus goes under equity section. Remember in your balance sheet, we did it before. And balance sheet has equity. Equity has share capital, share premium, retained earnings, and reserves. This revaluation surplus will go and you will park this money 50,000 in your reserves under the equity section. And that belongs to the owner of the business. So that is understood. But the problem starts. Another problem will start. I have solved my accounting side, and then I face another issue. Another issue is about the extra depreciation. Okay, this is the same double entry. I have shown you the double entry. My third issue is about extra depreciation. You know, what was happening before? What was happening before? My asset was 100,000. It had a life of 20 years. And I was charging a depreciation of 5,000 in my income statement. Now my asset has become $120,000 in value. And life of the asset is not 20 years because 6 years have already passed. So the remaining life of the asset is only 14 years. And if I take 120,000 divided by 14, this year my depreciation is $8,571. $8,571. So this goes to my P&L, my profit and loss account, my income statement. This goes to my income statement. And in my income statement, more expense will go. You know that depreciation is an expense. So how much is the difference? My extra depreciation is actually 3,571. This 3,571 is the difference between the new depreciation and the old depreciation. This is old depreciation and this is the new depreciation. And the problem begins from here. Now, when I go to my boss and I show him the income statement and he sees the profit, and he will say that, Mr. Ali, this time profit is very less. Why did we make so little profit? Our profit has gone down. I say, sir, profit has gone down because our depreciation expense has increased. And he say, why depreciation expense increased? I say, because we did the revaluation. Now, he will get angry on that. He will be upset. He will be unhappy because, you know, from profit, he takes dividends. He take this money home. He take dividend. He take this money home. In previous years, there was more money. There was more profit. And he used to take more money home. This year, there is less profit. And he can take home little money. And he will be very unhappy. You know what he will say? He will say to me that, Mr. Ali, you came to me, you said that there is a good news that we made a gain of $50,000. And then I asked you to give me this money and you say, no, you cannot give me because it is unrealized gain. So I just agreed with you and I said, okay, don't give me this money. But now, as a result of this thing, my usual profit which I make and I take home money, that has also decreased. So instead of giving me this gain of $50,000, you actually are giving me less money. So what benefit do I have it from this revaluation? I don't like your revaluation because your revaluation increased depreciation. More depreciation means less profit. Less profit means less dividends. Why do I need it? I don't need your revaluation. It does not give me any benefit. You don't give me this money. And in fact, what is my regular profit? That has also gone down. So what benefit does it bring to me? And he's quite right in saying that actually, you know, that makes sense. I say, okay, sir, well, how much is the difference? What is the problem? Where is the problem? And he said the problem actually lies with this amount. the extra depreciation. Last year you were charging 5,000, now you are charging more. Issue is 3571. 3571 because our profits have, if all other things are same, if my revenues and cost and all other things are same, other things do not change, my profit has decreased by this amount. If all other things are same, okay, my profit has decreased by this additional or extra depreciation amount. I say, okay, I will solve this problem for you. You have this issue of extra depreciation 3571. Please give me 10 minutes. I will think of a solution. What to do with that? Your profits have gone down and your dividends have gone down. Let me think, what can I do for you? And I will explain you what to do that. So anyways, extra depreciation, just like we discussed in this case, is 3571, which is the difference between the old and the new depreciation. Okay. Now, step number 4, what we do. Now, he is actually concerned about that profits have gone down by with 3571. So I try to console him. I try to somehow convince him. I say, sir, you should not worry, because remember that 50,000 I have put on the balance sheet in your name. So that belongs to you. And he will say that, when will you give it to me? I say, when we will sell the asset at the higher value, I will give you that 50,000. He say, Mr. Ali, I'm not selling the asset for another 10 years. This asset has a life of 14 years and I don't want to sell it. So if I'm not selling it, it means I'm not getting it. Do you want me to wait 14 years? What do I do? Give me this money to me. I say, okay, what we can do here, this 50,000, we set credit, revaluation, surplus. If you remember, we made a double entry, revaluation surplus 50,000, and we said debit non-current asset 20,000. And if you remember, we said debit accumulated depreciation 20,000. Okay, this is what we did. This amount is lying there, which is untouchable. I say, your problem is with 3571. What I can do, because revaluation surplus, you cannot take home money. You need your dividends. And dividends, they come out of the retained earnings account. Remember, in your equity, what do you have? You have 4 items: share capital, you have share premium, you have retained earnings. Retained earnings, these are the profits which are coming from the income statement. Whatever profit you make from income statement, it is transferred to retained earning. And from retained earning, the owners, they take dividend. And you have reserves. Okay. So right now, in the reserve section, this 50,000 is putting there. This 50,000, it appears here. What I can do, that the problem is with charging extra depreciation. This extra depreciation, I can transfer from reserves to retained earnings account, so that you can take it home. You can take your, dividends, or you can take your profits. So what I need to do, first I made a credit to revaluation surplus. Now I will say debit, revaluation surplus. The same account, I will make a debit with 3571. And I will say credit retained earnings. So what will happen, that this 50,000 will become 50,000 minus 3571. This will become 46,429. And in retained earnings, there will be 3571. 5,000 we were charging before. This year we charge extra depreciation. This extra depreciation you did not like, so I am giving it back to you. How do I give it back to you? I transfer it from the reserves section to the retained earnings section through this double entry. And as soon as this money comes in the retained earning, you can take out your dividends and take money home. Your problem is solved. And he says, what will you do next year? I say, next year I will do the same thing. I will repeat this transaction. Asset life is 14 years remaining. I will repeat this transaction 14 years. Every year, I will take out 3571 from this revaluation surplus and take it to the retained earnings, and you take your money home. See, 3571 multiplied by 14 years, that makes me 49994, some decimal points difference. So this is approximately 50,000. So you asked me this question, when will I get my 50,000? If I don't sell this asset, will I never get it? The answer is, I will give it to you on annual basis. This extra depreciation every year, I will transfer it from revaluation surplus to the retained earnings account, and from retained earning account, you can take your dividend home. And what will happen next year? Again, I will decrease it. It will become 42. Then I decrease it, become, I don't know, 38. Then I decrease it, become 35. And in 14 years, as the asset life finishes, this will also become zero. So that is an important concept. If I have explained it in detail, at least I tried to explain it in detail. If you do not understand, please repeat the video once more, okay? So this was the concept. Actually, I have explained you, there were 4 points. Third point was extra depreciation, and fourth point was revaluation account. I explained both of them on this slide. So this slide was about extra depreciation. Answer is 3571. Next point, the fourth point, last point was, what is the revaluation account at the end of the year? I also already have explained you this point, because you created 50,000 revaluation surplus, extra depreciation you subtracted from here, and 50,000 minus 3571, this is 46,429. This is the answer. Revaluation account at the end of the year. Okay. It is possible. This is the same double entry which I showed you before. Debit revaluation surplus, credit retained earnings. I explained you this before. And how much is the balance? 46,429. Okay. Now, it is possible that they may ask you that you did revaluation in 2018 with a $50,000. How much will be the balance on revaluation account in 2022? Then you will say, okay, 2018 I did. So 18, 19, 20, 21, 22. 5 years passed. So 3571 times 5. 3571 times 5. Every year, because I'm taking 3571. So total is 17,855. So in 2022, it will be 50,000 minus 17,855 or whatever. I mean, because I just subtracted 5 years amount. So this is your topic for the revaluation. What you need to understand, I go back very quickly. Step number 1 was, they asked us to calculate revaluation gain. We said that is 50,000. Then they say record the revaluation gain. We say debit non-current asset by 20, debit accumulated depreciation by 30, and credit revaluation surplus account by 50. Then they said calculate extra depreciation. We said extra depreciation was 3571. Then they say show the revaluation account end of the year. We said 50,000 for revaluation minus the extra depreciation 3571. That gives me 46,429. So these are the 4 points. Like I said in the beginning, they are not going to ask you all 4 in one question. They might ask you this number or this number or this number or this number. Whatever they ask, you should be able now to answer that question. I think that is all what I should be telling you at this stage in accounting. Okay. Remember, this is your basic fundamental course of accounting, and the details which I provided you, this should be enough to answer your questions or to develop your understanding. If you do not understand this topic fully, I would suggest watch this video one time more. And then if you still do not understand, then you should read the book as well. And then you should pray to God. That's all. Thank you.